The ATM screen flashes red. Declined. You try again. Declined? The card works. The account has money, but the machine won't give you cash. Behind you, 3 people are waiting. One of them is on the phone, voice rising. Another walks away quickly, heading to the bank across the street. You check your phone, the banking app won't load. You refresh. Nothing. It's 9:47 a.m. on a Tuesday, and something is very wrong. This is a simulation. A reconstruction based on historical banking crises, institutional response patterns, and the documented behavior of payment systems under stress. We're not predicting the future. We are examining what happens when a currency system built on confidence loses that confidence faster than institutions can respond. And we're starting exactly where these events always start. Not with a headline, with confusion. 6 hours earlier, the Federal Reserve released an emergency statement, unscheduled. The language was careful, technical, defensive, a reaffirmation of monetary stability, a reminder of institutional tools. But embedded in the third paragraph was a single sentence that currency traders recognized immediately. The Fed acknowledged ongoing discussions with foreign central banks regarding dollar liquidity arrangements. Not a crisis, just discussions. Except the Fed doesn't acknowledge discussions unless those discussions are already failing. Within 90 minutes, the overnight dollar funding rate spiked. Not dramatically, just enough. Enough for algorithmic trading systems to register a threshold breach. Enough for risk models in Tokyo, London, and Singapore to automatically begin unwinding dollar positions. No human decision required. The models were built after 2008 to move faster than panic. They moved. By the time New York opened, 3 things had happened simultaneously. The dollar had dropped 4% against a basket of major currencies. U.S. Treasury yields had jumped. And somebody, a pension fund or a sovereign wealth fund or a leveraged institution whose name we'll learn later, had tried to sell $7 billion in bonds and found no buyer at the expected price. That's when the phone calls started, not to the media, to each other. Fund managers, bank treasury desks, corporate CFOs, all asking the same question. Is this real? The first rule of bank runs is that nobody calls it a bank run while it's happening. They call it precautionary liquidity management. They call it normalizing cash positions. They call it responding to client requests. But what they're doing is moving money before someone else moves it first. And in a system where money is mostly digital, mostly instantaneous, and mostly trusted to be there when you need it, moving money creates a problem that didn't exist 5 minutes ago. You're back at the bank now, inside this time. The line is long, but not chaotic. Not yet. The woman in front of you wants to withdraw $8,000. The teller hesitates, then asks her to wait. A manager appears. There's a quiet conversation. The woman gets her money, but it takes 11 minutes. You're watching the teller count it twice. You're watching the manager watch the teller. When it's your turn, you ask for $3,000. The teller nods, types, pauses, asks if you'd accept a cashier's check instead. You say no. She counts the bill slowly. You notice her hand shaking slightly. You don't ask why. This is hour 8. The Fed has not commented further. The Treasury has not commented at all. But the interbank lending market, the invisible system that allows banks to borrow from each other overnight to balance their books, has effectively frozen. Not because banks are insolvent, because they don't know which banks might become insolvent if this continues. So they stop lending. And when they stop lending, smaller banks that rely on that market to manage daily cash flow start making phone calls they didn't expect to make. History teaches us that the gap between a technical problem and a public problem is almost always shorter than institutions expect. In 1907, the Knickerbocker Trust Company failed on a Tuesday. By Thursday, there were riots outside other banks. In 1931, the Austrian Creditanstalt collapsed in May. By September, Britain had abandoned the gold standard. In 2008, Lehman Brothers filed for bankruptcy on a Monday morning. By Wednesday afternoon, the world's largest insurance company was being nationalized. The pattern is always the same. Professionals panic first, the public panics second. And by the time the public panics, the professionals have already moved their money. It's early afternoon now. Social media is beginning to notice, not trending yet, just clusters of people posting photos of long bank lines, ATM outages, payment app errors. The posts are confused, localized, uncertain. Someone in Phoenix says their debit card was declined at a grocery store. Someone in Atlanta says their bank's website is down. Someone in Seattle says they waited 40 minutes to withdraw cash and the teller looked terrified. These posts aren't coordinated. They're not organized. They're just people describing something they don't yet understand is the same thing. The major banks issue statements, synchronized but not identical. They reassure customers that all deposits are safe, all systems are operational, all withdrawals will be honored. They don't mention that honoring withdrawals depends on people not all asking at the same time. They don't mention that their cash reserves, which are adequate under normal conditions, are designed for normal conditions. And they definitely don't mention that normal ended sometime around 9 this morning. We need to pause here and understand what money is in this system. The cash in your wallet is money. But most money isn't cash. It's numbers in a database. When you check your bank balance, you're not looking at physical currency stored in a vault with your name on it. You're looking at a promise. The bank promises it owes you that amount. And that promise works perfectly until a lot of people try to convert promises into cash simultaneously. Then the promise is tested. And sometimes, not always, but sometimes the promise breaks. By evening, the first cracks appear in payment infrastructure. Venmo delays start stretching from seconds to minutes. Zelle transactions hang in pending status. A few credit card terminals and grocery stores begin declining transactions that should clear. These aren't hacks. These aren't outages. These are system loads. Too many people moving money. Too many verification requests. Too many queries to databases that were never stress tested for an entire population simultaneously checking whether their money still exists. The Fed meets again. Emergency session, no statement afterward. That silence is louder than any words. Because when central banks go quiet during a currency crisis, it means they're choosing between bad options. They can inject liquidity, which might stabilize banks but signals the problem is real. They can hold steady, which preserves credibility but risks system failure. Or they can do something unprecedented, which might work or might accelerate the collapse, depending on how markets interpret it. There are no good options, only choices about which kind of damage to accept. Overnight, something shifts. International markets open and the dollar drops another 6%. That's 10% in 24 hours. For a reserve currency, that's not volatility, that's structural failure. Oil-producing nations who've priced their exports in dollars for half a century begin emergency consultations. China's central bank issues a statement so carefully worded that analysts spend hours debating whether it is a threat or a lifeline. European banks, holding trillions in dollar-denominated assets, start hedging positions they thought were safe. And in trading desks across the world, someone makes the calculation that's been whispered about for years, but never tested. What if the dollar isn't inevitable? What if it's just another currency that can fail? You wake up on day 2, your phone is full of notifications, news alerts, text messages, emails from your bank, your credit card company, your investment platform. They all say approximately the same thing. We're here for you. Your money is safe. Please be patient. You make coffee and try to order groceries online. 3 delivery services have suspended operations, not permanently, just until payment processing stabilizes. You check your brokerage account, down 18%. You try not to think about what 18% means in dollars. You try not to think about retirement. You think about it anyway. The grocery stores are different now. Not empty, but different. The bottled water aisle is gone. Canned goods are running low. Produce looks fine because nobody's panic buying lettuce. But rice, beans, pasta, anything with a long shelf life, it's moving. You're not here to panic buy. You're just here because you need food. But you grab an extra box of pasta, just in case. Everyone is grabbing extra. Just in case, the checker makes a joke about preparing for a hurricane. Nobody laughs. You pay with a credit card. It goes through. You feel relief, and you hate that you feel relief over something that should be automatic. The banks are implementing withdrawal limits now. Not officially, not legally, but practically. You can take out cash, sure, but maybe not as much as you want. Maybe we need to order that amount. Maybe come back tomorrow. It's for your protection, they say. It's to ensure everyone has access. And maybe that's true. But it's also to prevent the system from collapsing today instead of tomorrow. Because if everyone withdraws everything, there isn't enough cash. There never was. The system was designed on the assumption that they wouldn't have to provide it all at once. Smaller banks are in trouble now. The regional ones, the community ones, the ones without trillion-dollar balance sheets and emergency Fed access. They're making phone calls to larger banks, asking for short-term liquidity, offering collateral, getting declined or quoted rates that make the loans unworkable. Some of them are opening conversations with regulators they never wanted to have. Conversations about bridge financing, about orderly wind-downs, about mergers with stronger institutions. The language is clinical. The reality is that they're dying, and they know it. By midday, the first bank closes. Not a major one. A regional bank in the Midwest with 40 branches and a decent reputation. The FDIC takes control at 11 a.m., announces that all insured deposits are protected, all customer accounts will be honored, business will resume under new management. The statement is professional and calm. But every person with money in every other regional bank reads that statement and thinks one thing. Mine could be next. That's when the run accelerates. Not just lines at banks anymore. Real panic. People leaving work to pull cash. Families splitting up. One person going to one bank, another to a different branch. Elderly customers who haven't visited a physical bank in years, standing in line because their grandson called and said, "Get your money out." The banks can't handle this volume. They literally cannot. Tellers are running out of cash mid-shift. Managers are on the phone with armored car services begging for emergency deliveries. And the armored car services are saying, we're trying. We have 19 other banks calling with the same request. We can't be everywhere. ATMs go dark, not because they're broken, because they're empty. A typical ATM holds between $20,000 and $40,000. On a normal day, that's fine. Today isn't normal. Machines that usually go days between refills are empty by lunch. And the infrastructure to refill them, the trucks, the routes, the personnel, it's designed for routine, not crisis. You can't just fill every ATM in a city simultaneously. The cash doesn't exist in enough locations. The logistics don't work. This is where the second-order effects begin, the ones nobody planned for. Gas stations start demanding cash because credit card processing fees cut into margins they can't afford if revenue drops. Some grocery stores do the same. Landlords start calling tenants about rent due next week, asking if they can pay early in cash, just to be safe. Employers with direct deposit payroll wonder if that's going to work on Friday. Gig workers who get paid through apps watch those payments delay and delay and delay. The stock market has suspended trading twice today. Circuit breakers, automatic halts triggered when losses hit predetermined thresholds. It opens again and drops again and halts again. Analysts on television try to explain what's happening, but they're guessing. They use words like correction and volatility and adjustment. What they mean is collapse, but they can't say that. Not yet. Saying it might make it worse. Or maybe it's already as bad as it can get, and pretending otherwise just insults everyone watching. International consequences arrive faster than anyone expected. A cargo ship scheduled to dock in Los Angeles diverts to Vancouver because the shipping company does not trust dollar payments right now. An electronics manufacturer in South Korea halts shipments to U.S. retailers pending payment guarantee clarification. A pharmaceutical supplier in India demands payment in euros for a shipment of generic medications. These aren't political decisions, they're business decisions. And business has decided the dollar is a risk. On the evening of day 2, the president addresses the nation. The speech is short, direct, reassuring. The full faith and credit of the United States stands behind every dollar. The banking system is sound. Regulatory agencies are monitoring the situation closely. Emergency measures are being prepared. Do not panic. That last part, do not panic, it's the only part people remember. Because when a president has to say, don't panic, panic is already the correct response. Day 3 begins quietly. Too quietly. The banks open, but fewer people are in line. Not because the crisis is over, because there's no cash left to withdraw. The people who got out early have their money. Everyone else is checking apps, refreshing websites, calling customer service numbers that ring endlessly. The distinction between people who prepared and people who did not is now a permanent wealth gap measured in liquidity. Businesses are closing. Not all of them, but enough. A restaurant can't operate if suppliers demand cash and customers only have cards that might not work. A construction company can't pay workers if payroll doesn't process. A small retailer can't stay open if the cash they take in cannot be deposited, and the bank transfers they rely on are not clearing. These closures aren't announced. They just happen. Doors lock, signs go up, temporarily closed. Back soon? Except some of them won't be back. The federal government activates emergency economic powers that most people didn't know existed. Legal authorities from statutes written during the Cold War. The Treasury can now guarantee certain transactions. The Fed can now purchase assets it normally couldn't. Banks can now access lending facilities with relaxed collateral requirements. All of this is necessary. All of this is legal. And all of this confirms that the situation is worse than any official statement has acknowledged. But here's the thing about currency collapse. It's not symmetrical. Some people, some institutions, some nations, they prepared. They diversified. They held gold, other currencies, hard assets. They saw this possibility, maybe not this week, but someday, and they positioned themselves. When the dollar drops, their wealth doesn't vanish. It shifts, moves, redistributes. There are winners in every collapse. They just don't announce themselves. Foreign creditors holding U.S. debt are making calculations right now. China holds over $1 trillion in treasury bonds. Japan holds similar amounts. If they sell, they tank the value of their own holdings. If they hold, they're exposed to a currency losing value by the hour. So they do neither. They hedge, they negotiate, they use this crisis as leverage for concessions they've wanted for years. Trade terms, technology access, regional influence. The dollar's collapse isn't just economic, it's geopolitical, and the fallout will redraw power structures that have been stable since World War II. 72 hours in, the shape of the new reality is visible. Not resolved, not stable, but visible. Certain banks will survive, others won't. Certain currencies will rise as alternatives, others will fall alongside the dollar. Certain supply chains will adapt, others will break permanently. And millions of people will wake up in a world where the money they thought they had, they still have, technically, legally, but they can't access it, can't spend it, can't trust it the way they did 4 days ago. This simulation is based on documented patterns. Bank runs in 1930s America, currency crises in Asia in 1997. Sovereign debt spirals in Europe in 2011. The mechanisms are known. The triggers are predictable. The only unknown is timing. When does confidence break? And once it breaks, how fast does the system follow? You're standing in your kitchen. The cash you pulled out is in an envelope in a drawer. $3,000. It felt like safety 2 days ago. Now it feels like a countdown. How long does this last? How much is enough? What happens when this runs out? You don't have answers. Nobody does. The people on television don't know. The experts don't know. The government doesn't know. They're all managing a crisis that's moving faster than any response. Outside, the world looks almost normal. The sun is setting, cars are driving, lights are on. But underneath, in the invisible systems that make modern life possible, something fundamental is broken. And the gap between what looks normal and what is normal, that gap is where the real damage lives. If you've watched this far, you understand what most people won't until it's too late. Systems built on trust collapse at the speed of communication. And in a world where communication is instant, collapse can be too. There's more to explore here, more patterns, more history, more mechanisms. If that matters to you, there's a subscribe button below. Or don't. Either way, the simulation continues whether you're watching or not. The question was never if. It was always when. And what you do in the space between when and now, that's the only variable you control.